The central banks filled the void coming out of 2008 and 2009 with all the and they became the purveyors of credit. They became the emperors of the business cycle. And I think what we're going to start to see is that being passed back. 100% depreciation on CapEx kicks in this year, right? Is everybody going to pile into gold? Is that the end game? We're going to own gold and silver, and maybe we'll start buying more Bitcoin.
Jim Thorne joins us once more. He's the chief market strategist at Wellington-Altus. We'll be getting his outlook for 2026 and what's next for the economy. 2026 is Trump's economic endgame, he writes. We'll find out what that means, and we'll find out what a new world order, according to Canada's Mark Carney, means as well. Welcome back to the show, Jim. Good to see you.
Good to see you, David. Happy New Year.
Yeah, we're going to find out what you mean by Trump's economic endgame and what that looks like. I want to start by talking about Davos. The World Economic Forum at Davos this week gave us a lot of sound bites for us to react to, starting with Mark Carney's speech, which a lot of liberals have been calling the best speech of all time. I want to show you just a clip of that, and then we'll react together.
Let me be direct. We are in the midst of a rupture, not a transition. Over the past 2 decades, a series of crises in finance, health, energy, and geopolitics have laid bare the risks of extreme global integration. But more recently, great powers have begun using economic integration as weapons. Tariffs as leverage, financial infrastructure as coercion, supply chains as vulnerabilities to be exploited. On Arctic sovereignty, we stand firmly with Greenland and Denmark and fully support their unique right to determine Greenland's future. Our commitment to NATO's Article 5 is unwavering. So we're working with our NATO allies, including the Nordic-Baltic Gate, to further secure the alliance's northern and western flanks, including through Canada's unprecedented investments in over-the-horizon radar, in submarines, in aircraft, and boots on the ground.
I'll stop here. Let's just talk about what he said in the opening. Rupture. What does he mean by that? What's your interpretation of the speech overall?
It's a continuation of a speech he gave at the Council of Foreign Relations a couple of months back, and it's a recognition that the Keynesian world, or the globalization, or the post World War II order is done. It's over. So at least he's making an acknowledgement of it, right? We can take an interpretation of what that means for Carney and how the left is interpreting it. But the first step, in anything, is recognizing that there is a change, and that's what he's done. And I think that's also what he did with the, using, New World Order, right? We are in a different environment, which I would suggest is defined by the Trump doctrine.
What is the Trump doctrine, Jim? Well,
to me, the Trump doctrine is really emulates from the national security doctrine. And what's different about this, David, is this time around, it's 35 pages. It's very clear. It's written. It's concise. It's focused. And it really talks about, what President Trump is basically saying is that, we view the Western Hemisphere as ours. And no foreign actor that we do not like is going to own factors of production, supply chains, or ports. And in that document, the president and his team mention China repeatedly, really don't mention Europe. And I think they mention Europe once, and they don't even mention Canada. And I think the interesting thing about that, David, is when that document came out, the consensus view in the city of London and New York and in Canada was that we could wait this guy out. It was just a PowerPoint presentation. And then the president went and, did a historic military action in Venezuela and, snatched Maduro. And I think that focused everybody's mind that this is real. And David, even Chatham House, which is an old school think tank, in London agrees that, there's no more waiting it out. Mr. Trump is serious. He has a clear, concise, transparent policy, and he's going to implement it.
Do you think that allies are abandoning the U.S., or is this just posturing from politicians? Carney just made a deal with China in the midst of all this. As you're aware, 49,000 Chinese electric vehicles to be sold to the Canadians or the Canadian market every year at a 6.1% tariff rate, or 6.5, I can't remember exactly, but 6 point something, which is a lot lower than tariffs on American cars and down from 100% prior. In return, Canadians can now visit China visa-free, and Canadian farmers have a contract to sell canola oil, among other grains, to China, which is huge. That's basically snubbing American farmers. Okay, that's great for the Canadian economy, I guess. What does that mean strategically for the U.S.? Is that the right choice for Canada to be making strategically as well?
Well, I've said on the record that it's a litmus test. And I also, I'm anchoring off of the president and what he says, not his cabinet. And, he said, if you can get a deal with China, you take it. I also think that the structure of the deal is Trump-esque in that it is very targeted, very focused, and businesslike, as opposed to how Kuzma or the free trade agreements look like. So I think it's a litmus test, and it's going to be very interesting to see how I think there's going to be a grand bargain between President Trump and Chairman Xi in the spring on a big trade deal between the U.S. and China. Having said that, if you look at it objectively, and I know the Americans are upset, fair, but is it performative politics and media, right? Let's be honest, right? Canada imports about 650,000 cars a year. 49,000 is not a big nut. And think about this, David. Tesla already exports cars from China to Canada. And so Tesla benefits. There are U.S. manufacturers that are manufacturing low-cost electric vehicles in China that can get into Canada. So he offers a targeted deal to basically help agriculture, right? And he really doesn't, in my opinion. Now, let me be clear. Maybe the president's going to come out and say he doesn't like it. But up until today, the deal does not cross his red lines, like I said, in the national security doctrine, which is, owning a significant portion of natural resources, supply chains, and what have you. So it's a business deal. And look, Canada used to make 2.5 million units in cars a year. It's down to about between 1.3 to 1.5 million. David, that's going to go down to about 750,000. So, I mean, the way I look at it, and you can look at it so many different ways, is Carney is giving the implicit nod that, you know what, the auto industry really isn't the future of Canada, right? And so I sit there and I go, look, the United States is still going to be the number one trading partner. And should we not, going back to the national security doctrine, and I'm just anchoring off of what the president's saying, if the United States is going after economic sovereignty, and Kuzma and the free trade agreements traditionally are being tore up, should not Mr. Carney go after economic sovereignty for Canada? Right. So I think it's a deal. I like how he's embraced Trump's philosophy. It was really good for agriculture, for Saskatchewan. And the thing I'm going to say that's going to probably be a little bit controversial and provocative, David, but if you go back and you just compare the two economies, if folks are saying that Canada is cozying up to China because of this trade deal,
Yeah.
the US economy is much more on a relative basis integrated with China. So if Canada is cozying up to China, the Americans are in bed with China. Okay. And so I think we need to sit back and look at the data. And I think this is just a first salvo in seeing how Mr. Trump and Chairman Xi, President Trump and Xi come up with a trade deal. And then I would expect, look, I think this is a roadmap for the trade agreement negotiation between Canada and the United States. It's going to be sector by sector. It's not going to be a free trade agreement. So I think it's okay. I'm surprised that so many people are freaking out about 49,000 units. I mean, Tesla's shipping cars in right now. So I don't know. I think it's a good deal.
Before we continue with the video, let's talk about today's sponsor, Monetary Metals. You already know why people hold gold, because it's real money. But what if your gold could do more than just sit in a vault? Well, that's where Monetary Metals comes in. They offer a way for you to earn a yield on your gold paid in physical gold. Through their leasing marketplace, you can earn up to 4% yield per year in gold. Instead of paying storage fees, your gold works for you. And because that yield is paid in gold, not cash, your stack grows no matter what the dollar does. Thousands of clients already earn a monthly yield in gold through Monetary Metals, so don't just hold it, put it to work. Go to monetary-metals.com/Lynn, link down below, or scan the QR code here to learn more and start earning real gold on your gold today. I think people are freaking out over what this symbolizes, which is a stepping stone towards warming relations with China and Canada, which is, I'm not saying that's a bad thing, but I think opponents of this may point to the fact that this is probably the beginning of the end of U.S.-Canada relations, the beginning of, let's say, a new alliance between Canada and China, or China's allies, right? That's.
I hear you. That's like people thinking that President Trump was going to use military force in Greenland. Come on, the number one trading partner of Canada is going to be the United States. We're going to they have to go through some economic integration, and then I would say back. I mean, if folks are upset about it, well, I mean, why aren't the Americans upset about how much they're integrated with China? And as Secretary Bessent say, it's de-risking, not decoupling. So it's performative. It makes great media, right? Everybody's freaking out, but go and look at the facts. And so I hear what you're saying, and I just sort of stand back and smile and go, holy smokes, right? I mean, you really don't think that the United States supply chain is still significantly dependent on China? Come on, look at the economic data.
So Trump just basically announced that he made a framework of a deal for Greenland. So he's no longer interested in taking the entirety of Greenland, at least for now. Maybe that'll change by tomorrow. We don't know. But in the last 48 hours, he's basically switched his stance. He doesn't want to invade Greenland anymore. He doesn't want to buy it anymore. But he's made a framework of a deal. The Golden Dome is going to be extended to Greenland, more military bases, so on and so forth. But at the same time, he's made this threat just today. Hours ago, as reported by the Wall Street Journal, Trump threatens big retaliation if Europe dumps U.S. assets. So there's already a pension fund in Denmark that sold $100 million worth of treasuries, which is a drop in the bucket, I know, but this symbolic move may be the start of larger dumping of U.S. assets, according to Trump, right? He said if they do, they do, but if that would happen, there would be a big retaliation on our part, and we have all the cards, he said in an interview with Fox Business. Why would he be making this threat? Are you seeing evidence of Europeans making moves to dump U.S. assets right now?
No, in fact, I think if you look at it, actually, foreigners are buying more U.S. treasuries than they have in the past. So I think it is a drop in a bucket. I think it's a mistake, and I just think it's President Trump projecting power. I mean, you're going to sell U.S. treasuries. What are you going to buy? Greek bonds, Greek sovereigns, French sovereigns. What are you going to buy? Right? You're going to go in, so I think it's, like I said, it's a lot of noise. And I anchor off of, I listen very carefully to what Secretary Bessent and Ludnick say and the president. And they're transparent, they're consistent, and they're implementing their strategies. And I think a lot of the stuff that people are doing is emotional. And, in 72 hours, they're going to, in a very short period of time, they'll regret the action that they took and they'll regret what they said.
What happens if, let's say, the entire world does band against the U.S. and sell assets? Let's just take that hypothetical to reality. Which assets would they be dumping first?
Oh, yeah. I mean, you talk to a lot of people on your channel or your podcast that hold the view that U.S. Treasuries are no longer the safe haven, right, of the store of value, and U.S. dollar, the end of the U.S. dollar dominance is over, right? Yes, of course, if everybody punted U.S. dollars and U.S. Treasuries, what would the world look like? It would look like a very different place. But I just don't think it's a very rational or well thought out. Or you're going to go buy you're going to go buy Russian bonds, right? Is everybody going to pile into gold? Is that the end game? We're going to own gold and silver, and maybe we'll start buying more Bitcoin. And so I think it's, the end of the dollar, the end of the Bretton Woods. I am totally on side that we're into Bretton Woods 2.0, but I really don't think you can build portfolios on apocalyptic hypotheticals that you're presenting, such as that.
The broader issue here is whether or not we're entering an era of the end of U.S. dominance in global trade and finance. So this is what Ray Dalio had to say, I think, in an interview at the conference in Davos. And it kind of mirrors what you've told me in the past. I'll just play for you this clip real quick.
Remind us, this is the beginning of the end for the prescience of the U.S. dollar.
It's the beginning of the end of the monetary system as we know it. It's not just the U.S. dollar, it's the fiat monetary currencies. So the UK, the euro, Japan, China all have similar debt problems and so on, and are dealing with the same interrelationships, which is the reason you're seeing gold being chosen by the central banks. They want a currency. Gold has always been the main currency, and it's the only non-fiat currency, in other words, not the currency that can't be printed, that they want. And so that's why you're seeing central banks move and sovereign wealth funds move to gold, and that's the nature of the shift of the monetary system.
I understand what he's saying. I'll get your reaction, but it's not like the debt problems just started happening since like last year. It wasn't an overnight problem. The G7 countries have been piling on debt for decades. Japan has always had a very high debt to GDP ratio. So the logic that central banks all of a sudden are adopting gold now because of higher government debt, I don't know. It seems like there's something else going on behind the scenes, because government debt was always a problem, and gold was just starting to skyrocket in the last two years.
Yeah, I agree with you. And the narrative. I mean, Keynes in 1945, warned the architects of the Bretton Woods system that using the U.S. dollar as the medium of exchange of the global economy, we would end up where we are right now, right? He wanted a non-sovereign currency, right, to be the currency of the world as a medium of exchange. So we are where we are right now. I mean, we should add, there's a lot of things that I look at with gold and what's going on, and I can look back to the Biden-Yellen team that basically attacked assets of the Russian central bank in the Eurodollar market. I can look at, the Biden Yellen team with the EU wanting to go after Russian holdings of U.S. treasuries. That is a binding contract between two sovereign nations. And, the United States basically, some of the folks said, well, we're not going to uphold that. Well, David, if you were the king of whatever, Middle East oil state, I think it would be prudent to diversify away some of your money away from USTs and US dollars, given the fact that at any point in time, a legally binding contract would not be upheld by the president of the United States. This is not Mr. Trump's problem. Mr. Trump did not like this views. So if we're going to sit there and freak out about it, we should ask about what the heck was Janet Yellen, what the heck was Biden doing, and what was heck was all the Davos crowd doing, basically wanting to attack Russian holdings in U.S. sovereigns. In Treasury. So that's how I look at it. And I think the other interesting thing about what Mr. Dalio is saying is he's absolutely right. And that's why the Americans, and that's why when you hear Scott Bessent talk about when you're the head of the G20, they want to basically get to a world where we can run the economy hot, right? Where we can get strong economic growth. And let's introduce a new economic view, like kick the Keynesians out, that view that any economic growth is inflationary. David, true inflation just came out with a 1.2 number on CPI, right? And, supply side economics is keeping the demand curve fixed and shifting the supply curve out, increasing GDP and bringing prices down. This is the regime that we're dealing with and moving into. And we're seeing a lot of Keynesians running around because, in my personal opinion, they're losing control. So he's right. We got to do something with the debt problem. But since I've known you, we've talked about this.
Yeah.
So I look at the movements of what's going on in the currency markets and the treasury markets is just a readjustment. And then I also look at the Clarity Act coming. And I really do think that, one of the things that's going to be very interesting is stable coins in Bitcoin and Ethereum about we're going to have a new digital Bretton Woods 2.0 that will be backed, I think, by U.S. treasuries and the U.S. dollar. So as I wrote again, I am not one of those people that think at the end of the king dollar. I still think it's going to be a U.S. dollar denominated system, but I think it's going to be on a blockchain. And, can the U.S. dollar fluctuate short term because of fundamentals? The fluctuation in the dollar has nothing to do with the king dollar, the U.S. dollar and the U.S. economy being the backbone. And who's going to replace it?
So let's talk about this Bretton Woods 2.0 that you mentioned to me prior. It would emerge from stablecoin legislation, creating demand for treasuries, you argued. The banks are lobbying against this, though. So you can see here from CoinDesk, the American Bankers Association 2026 policy priorities call for banning yield on payment stablecoins and revising open banking rules to promote what it describes as consumer protection and competitive balance. Is this going to derail your thesis, do you think?
Look, whether it's, the head of Coinbase or, Saylor, they've said it out loud, right? You can get good yield, great yield in, I'll call it crypto world. And what is at risk for Wall Street is the stranded capital that exists in Wall Street where they don't pay a fair rate of return, right? Whether it be money in checking accounts or whether it be the trillions of dollars that sit on Wall Street where they're not giving a high rate of return. It's working capital, right, David? You've got a company, you've got 15 million in cash, you need 1 million for working capital. So you put that in cash, that other 14 million, they're giving you a terrible rate of return on. Right? Saylor is coming in and he was vocal about it and basically say, I am going after that stranded capital. And the stable coins are the same thing. And so it is rational that the Wall Street would push back because, they're killing the golden goose. They're going after the golden goose, which is Wall Street not paying fair rates of return for the usage of somebody's capital in a fractional banking system.
Okay, so let's segue into the final segment of our conversation, which is what I mentioned in the beginning, your 2026 forecast. I'll just read this tweet. 2026 is Trump's economic endgame, a mainstream revival wrapped in a populist market surge with impeachment on the line. He's pushing cheap credit cap lending rates. So 10% capped on credit card rates and $2,000 tariff rebate straight to consumers. By the way, he's since rescinded this. He claims that he doesn't remember saying this, so that's not happening anymore. The Fed stays dovish to protect growth while the Magnificent Seven drive the AI boom, and crypto cements itself as a speculative outlet for excess liquidity. So what are the main asset classes that will benefit this year from what you describe as Trump's economic endgame in 2026?
So Trump and Bessent are focused on bringing economic growth back to Main Street. The key term that they use is productive capital. So they want to basically be also viewed as attacking affordability as well. And so what you're seeing right now, David, in the market is you're starting to see the S&P 500 equal weight, small cap value, regional banks starting to outperform. You know, when does the U.S. consumer kick in? So the key in this is that, you know, the AI trade is there, but it's not the only game in town. And what Mr. Trump is going to do is to try to do whatever he possibly can to get money in the pocket of consumers to generate economic growth within Main Street, not Wall Street. So no more financial engineering, focus on deregulation and tax cuts to focus on productive capital and help the consumer come back. And so that means the breadth is going to widen. And if we can get him, and this is my editorial on this, I think what the president needs to understand is within the through line is he needs to dial that back the rhetoric, because the market's not going to go higher with all this good news. If we're going to shift from Greenland to Iran to, you know, going after Jamie Dimon, I mean, he's got to stop the noise and the uncertainty and if he would just stand back and allow the market to go, I think we could see somewhere between 8,000 and 8,400. So my thesis is that he understands this. He'll stop complaining about it and he will get the market going. And therefore you would start to see Trump take a less aggressive, abrasive positioning for the rest of the year and re-engage back in 2027.
And what about monetary policy? You've been critical about Jerome Powell's video statement claiming that the DOJ is subpoenaing him because of political reasons, not because the Fed actually, you know, went over costs and whatnot. We can talk about that, but that aside, today we had the core PCE come out, which is the measure of inflation that the Fed tracks at 2.8% as expected. It's consistent with the forecast, slightly up from October's 2.7 reading. And on a month-to-month basis, it's up 0.2%. So new deviations from expectations, but still not coming down. What does this all mean for monetary policy going forward?
Well, I think, you know, when you look at it, it's services. I mean, in Supercore month over month, it's really interesting. It's ticket prices for the World Cup are starting to come through on a historical level. So I just don't think that inflation is the problem, and I don't think the job market is as strong as we need to be that it is. And to me, what he needs to do and what the Fed needs to do is just get back to neutral and step back. The presence or the essence of the 2026 forecast is that we're going to slowly start to see with deregulation is that the baton of credit creation and the managing of the business cycle will go back to the private sector away from the central banks. The central banks filled the void coming out of 2008 and 2009 with all and they became the purveyors of credit. They became the emperors of the business cycle. And I think what we're going to start to see is that being passed back. So I look at what's going on. And then if you take out shelter, you know, we don't have an inflation problem, right? And so then you sit there and go, okay, fine, full stop. Look, the Fed, in the Federal Reserve Act, they do have oversight. And the question I have and what I question is the fact that why didn't Jay Powell just answer the inquiries about the the renovations of the building. I find it very interesting that other central bank heads came to his defense. I think it's also very interesting that former heads of central banks and treasuries that were signed a letter somewhat similar to the letter that the national security folks did with the Hunter Biden laptop. I framed it with a Shakespearean quote that they thus protest too much, methinks. And so what I am suggesting is, look, these guys aren't emperors. There is oversight. I don't understand why Powell did a public game. But then again, I go over to Davos and I look at how Christine Lagarde is acting in Davos over the past couple of days. And it is explicit now that she is political. She is making statements that an independent central banker who wants to be left alone on monetary policy, well, if you want to be left alone, then stop making comments about Howard Lubnick, right? And stop acting the way that you did at dinners in Davos. So let's be honest. They have a right to ask for the data for the renovations. The actions of why they didn't answer it, I don't know. And to sit there and to claim that asking for innovation references or data on the renovations, right? And we know that it was referred last summer, how that you can extrapolate that into setting interest rates. I mean, David, you asked me about the PCE and the CPI. Hey, David, no tariff inflation, right? Powell's wrong again. You know, I mean, there's an article in the Wall Street Journal about, when Bessent talking about, if Powell was ahead of a private sector company, he would have been fired by now, right? And everybody's running around, well, what's the basis of in this new world? Well, how about incompetence? How about Powell and the Fed are completely and totally incompetent? And why can't we say that honestly without people invoking that somehow that is affecting how monetary policy is being set? Let me be clear. The Fed needs to be independent in terms of setting monetary policy, but to sit back and to look me straight in the face and say that there hasn't been mission creep and there haven't been acts of clear political bias by Western central bankers, that's folly.
Do you think that Trump will retaliate more against the Fed after Jerome Powell's political statement, by appointing somebody even more dovish than what we're expecting now? And by the way, nobody that has been proposed has been selected yet. So Trump clearly is looking for somebody else.
Yeah, I think he's going to nominate Kevin Warsh. And he's been very transparent about the structural change that has to happen at the Fed. It needs to be more focused. And so, yes, we are. And, this is, and I don't agree with Mr. Mohammed El-Arian on a lot of things. But I agree with his point that Powell should have resigned. And I think no matter what happens, the Keynesians have had control of the Fed. It really started to creep in the late 1990s, but it really came in hard when Bernanke got involved in the 2000s. We need to get a Fed that is balanced in their views. We need to and diversity means let's get some supply side economists on there, right? Let's not get all Keynesians on there. Right? Let's get a diversity of thought. But I think the big step is going to have to be over the next couple of years is that we start focusing on economics and we move away from the dogma of MIT and Yale and move back to the dogma or the views of the University of Chicago. And that's all I have, when I'm sitting there arguing with them, I'm sitting here going, all I'm doing is just basic third year macro and going to the chapter where we look at the supply. everything that they've done, every mistake that they've made has been that they've only focused on the demand side of the equation. It's really unfortunate the way it's gone. But having said that, we should expect that the Fed becomes more supply side oriented in their views. And that may take some time. So when you sit there and you hear people say, well, it's going to be the Trump's Fed, and this what he's going to do is he's going to appoint supply siders. And if you listen to Moran and his talk about what, taking out shelter and the effects of interest rates on supply, that's third year macro, right? And how that is, and so you just sort of, as a PhD, at being trained, I mean, you're sitting there scratching your head saying, I mean, if I was at the Fed right now and I had a PhD, I would be banging my head against the wall at the incompetence of the FOMC and their unwillingness to take a holistic view, take all aspects of economic theory in setting monetary policy. And that's not happening right now.
Monetary policy divergences, we'll keep track of that throughout the year. I wonder if interest rate differentials widen, how that's going to affect currency pairs and also monetary policy. The Bank of Japan, what are they going to do? Their GGB spiking. Yeah.
So what I would say to you is, and I learned this from some really smart people very early on in my career. The interest rate differentials don't drive currency.
Okay.
Which is, and so if that was the case, tell me, why does the euro trade at a premium to the US dollar? That was the example I got, and I was embarrassed at a steakhouse in New York so it's about economic fundamentals, right? So I think you're right about Japan, right? I mean, that's a whole other segment, but look, I mean, they applied extreme progressive left fiscal policy in Japan, and they didn't open up their markets for agricultural products. And when you get inflation that's caused by a shortage of rice, and the Bank of Japan now thinks that you no longer need yield curve control when you've got debt to GDP at 250. Well, bad things happen, right? And look at the 40-year and the 30-year, right? Look at how vertical they went. And so and then you've got a new prime minister who's coming out for election, who's basically promising everybody for everything, but not telling how she's going to pay for it. So Japan has to get their house in order, and they have to recognize the fact that, they're limited in what they can do because of the levels of debt. But what I would suggest, what they need to do is open up their economy. If they would open up their economy, you wouldn't have had the spike in rice, and therefore you wouldn't have the food inflation. Right? So that's how I look at Japan. They've got to get with the program.
Let's finish off on your outlook on markets. Tying up everything together, what would need to happen, first of all, for Bitcoin to start catching up to the stock market?
Well, I think we got to get rid of the clarity. We've got to finally settle the Clarity Act. Mm-hmm. That's one. Two, there's a lot of chatter of what happened on October 10th with problems with the exchanges, that you still have people, selling Bitcoin and Ethereum, to deal with that event. But David, I look at Bitcoin. If you're, I say that use charts as your guide. And one of the things that I find very interesting is if you look at a chart like Micron, right? Micron is finally going through that once in a generation re-rating where, it was priced off of NAND. Now it's priced off of DRAM. It's dirt cheap, and we're in a memory cycle, super cycle. Well, David, if we were talking 5 years ago, that would have been the narrative, and then it happened, and now it's gone, right? So I think with Bitcoin it's the same trade as when you look at the Ray Dalio clip, okay, about the debt, and you need diversification. And once the Clarity Act gets through, I think there's going to be allocations within Bitcoin, right? And I like the chart. I like that it's saying here, and I want to buy low and sell high. And so that's what I feel about with Bitcoin. And I think with everything, Small caps are finally breaking out. We've been talking about small caps going back to its historical valuation relative to the S&P 500 and the NASDAQ 100 for years. Is this the year? And if it is the year, David, that's going to be a parabolic move. Like all the moves are going to look like gold and silver and Seagate and Micron. You know what I mean? And so you've got to plan your work your plan, and realize when they break out, they're going to go in a parabolic move. Well, old trader once said to me, you sell parabolic moves, right? So look, I'm bullish on gold long term, but it's gone too far too fast. I'm bullish on silver long term. It's gone too far too fast. Right? I love Micron. I love Seagate, all these names. But at the same point in time, you've got to use the charts, and you've got to trade and recycle the capital into names that have sound fundamentals behind them. But for whatever reason, they haven't broken out, or the thumb's on the scale and they're not going up for some reason. Majority of asset classes are going to go up during this bull market. Every asset class will have their day.
Are you allocating more outside of the U.S., for example? The TSX in Canada has outperformed the S&P in the last 1 year. Makes sense given how far resources have gone up, but maybe we can continue this pivot. Yeah.
If you take out the 20% of materials, or you normalize for materials, the S&P has held its own relative to the TSX, right? I think you've got to let gold and silver, so TSX is 20% materials, but it's a different type of materials and relative to the 3 or 2% in the S&P 500. The materials in the S&P 500 are typically chemicals. In the S&P and to the TSX, I think it's 15 to 16% gold and 1% silver. Right. So I think, what we're getting right now is a blow off top in gold. Right. I think it possibly goes to 5,000. It could go to 5,000 short term, and then all the rugs will be pulled. Right. And then I think what it needs to do is to have a nice digestion period. Right. Maybe it finishes the year at 5,300. Right. I think it's 10,000 by the end of the decade. But I think the big money's already been made. And if the big money's already been made, then that 1 period of time where TSX outperforms the S&P because of gold and silver is over.
Final question. What happens to AI stocks in this period of boom? Bubble pop? Rotation to something else? Or continue momentum?
Use your charts. I think, the old adage, Dave, is that we're building out a network, which means hardware, not software. And then what will happen is each will have their day. So, I'm expecting, let's do a hypothetical. Trump does a deal with Xi in the spring, and then all of a sudden NVIDIA can sell more into China. Then basically NVIDIA breaks out of a 6 to 7 month consolidation pattern. It goes and runs, and everybody sells Micron and goes into NVIDIA, sells Avago, goes into NVIDIA, right? That's the type of market that we're in. So I like AI. I like network. My view is bull markets or bubbles are pricked not by valuation, but by liquidity. And so with the big, beautiful bill act, 100% depreciation on CapEx kicks in this year, right? So I think people are going to be motivated to spend in all aspects of CapEx. And I think AI will be fine. But let me be clear, David, if you and I were building a portfolio today, looking out 12 months, we do not need to have the only expression in that portfolio AI. It can be there, but it's not the only game in town. It's a significantly lower weight in a diversified portfolio.
Let's catch up next time. This has been a great talk, Jim. Where can we follow you? You've been on fire on Twitter.
Dr. J Strategy is where you can grab me. I also post there my new, my market insights, and I'm on TV and media in New York and Canada.
Okay, good. Well, we'll put the links down below. So follow Jim there, and Wellington-Altus as well. I'll put the link down to the website. Thanks very much. We'll see you again next time, Jim.
See you again.
Thank you for watching. Don't forget to like and subscribe.